So Doug, I'm feeling a little bearish today. Is it time to jump off a bridge?
Well, we should talk about that.
The S&P is down year to date 18%, Nasdaq's down 27% year to date.
It's
not feeling good.
No, it's one of the worst starts of a year that we've seen. Certainly one of the worst that I've gone through. But one of the things I would say is, the Federal Reserve is the main reason for this downturn, and the war in Ukraine. But I think mainly the Federal Reserve. And what they're trying to do is stop the inflation. And they've done that by ending quantitative easing, which was literally pumping $26 billion of cash into the market every month. And then they've increased the interest rates. The combination of both of it is tightening down the money supply. And that's what's causing all the problem in the market. And so the first quarter we've seen is negative for GDP. If the second quarter is negative, that means we're in a recession. And I would say, most people are saying 50%. I think it's actually higher. I think it's probably more like 75%. But let's talk about
75% chance
of going into a recession.
Oh.
Yeah. But let's talk about, first of all, I also don't think it's going to be a major recession. I think it's going to be a minor recession. And then the other thing is, if you look at the history of the market, the stock market with recessions, at the beginning before the recession is even, realized, the market starts going down. And when we look back, we can actually see that happen. And November was the peak, and since then the market's been going down. But when you're in the darkest part of the recession, when everything looks like it'll never end and it's just going to be absolutely awful, the stock market takes off and it'll head off to new highs. And people think, well, they're going to wait until the recession's over. They're not sure on the market. And the answer is actually the market will take off.
So don't jump out of the market thinking if you hold on to your cash, you're going to get back in time, because you might miss
You'll definitely miss it. So here's another thing. If you were in November and you held until the market gets back to even, and it will someday, when that happens, your annualized rate of return, studies show, will be 7.5%. So by staying put, you'll be better off than if you move the money to cash and sat it in the bank with the low interest rates.
So even if this year ends in the negative, because you're talking about annualized numbers, that means it'll average out to be positive.
That's correct.
As long as you hold on.
I don't think it'll be that long, first of all. I mean, usually recessions are only 6 months, 8, 12, rarely do they go longer than 8 months.
Mm-hmm.
There's been a couple, but not very many, and I don't think this one has the makings for that to happen. So I think it'll be a shorter recession, but you can't be assured, of course.
And I guess the silver lining there is that would help tamp down inflation, so that we're not spending so much on goods and services.
Right. So what should you be doing in this period? One is not panicking and getting out of the market. I have been personally adding into quality companies that have little or no debt, companies that are growing at excess of 15% a year in their earnings, companies that can make money in recessions that are not cyclical. Those are the areas that I think are quite attractive. And of course, we talked about buying commodities.
Mm-hmm.
We think they're attractive because of inflation right now.
And of course, we always try to put our clients into quality companies, because we're always thinking about the long term.
And we should also talk about the difference between passive and active investing.
Mm-hmm.
In passive, you're basically in an index. You don't have active changes in your portfolio. They basically change with whenever the index changes. In active, you actually have a manager or a team of managers that are trying to maximize the situation. And so right now, those active managers are shifting their portfolios into stuff that when the market takes off, they will exceed the market on the upside.
So a lot of the mutual funds, for example, would be an example of an actively managed
Some
portfolio.
of the ETFs also
Mm-hmm.
would be examples.
So even though we might not see the price reflected in the work that they're doing right now, they're seeing this as an opportunity moment to realign the portfolio and really make money
Well,
when we come out of this.
It's funny you say this because I've been up at some of these, mutual fund places and active managers, and they love this period. They're running around having a great time because this is when they can set up the portfolio for the big numbers later on. And if everything's constant up, they're not able to exceed their indexes. So for them, this is an exciting, fun time, even though it's not an exciting, fun time for us. And actually, they don't even understand why we don't like it.
I'd like to imagine.
So it's a very scary time, and really, if you have friends that are in a scared time, please give us have them give us a call. We'd be glad to help them. Or if you have any concerns, please give us a call. And in the case of you, Sarah, I think you should jump off the bridge.
What?